WTI crude rebounding off its lows of the year, rising another 2% plus today. The commodity, which hit its lowest level since last December on Friday, is now up more than 8% this week. So is the worst over for crude? Let's bring in Paul Sankey of Sankey Research for more on what 2023 brings. Paul, good to see you. So we've seen the lows for crude, you think?
For this year, I think so.
Yeah.
But, I think if you look back at 2018 and the taper tantrum, we had very similar market action that we expect every year anyway from Labor Day into the beginning of winter, which is essentially what we've seen, a significant fall off in prices since Labor Day, essentially down to the lows that we just saw. And if you look at what happened in 18 into 19, we saw crude running hard into driving season. So we're looking for $120 Brent, which would be $115 WTI by driving season, which would be May next year, 2023. So yeah, the answer to your question is yes.
So what happens with energy equities with this backdrop, with this roller coaster?
Well, that's a very interesting question, Melissa, because what we've seen here on the downside, certainly for the first part of the big down move in crude, was that the energy equities outperformed significantly, which say they didn't go down as much as oil did. I think they were kind of discounting 80, and they were okay with a move down to 80. I think when the risk got that we broke below 80, then it became a problem for the equities in that last leg. And as you can see now that we're getting this beginning of winter, very cold in Europe, Russian oil coming off the market, et cetera, all the things are coming together. You can see the equities are moving very well here as the crude price moves.
So, Paul, put your economist hat on real quick, because if we get a 50% rally in Brent, I think the math is right, by the spring, that makes this Federal Reserve job extraordinarily more difficult than it is right now. Agreed?
Well, yeah, look at the Saudis. I think that was really upsetting the administration, right? And one of the scary things here from an administration point of view is that the announcement OPEC Plus a couple of months ago that they would cut 2 million barrels a day, they never cut exports. And so the potential is there, I think, for Saudi to move more towards a $100 type target, which I believe they have, than allow oil to stay down here. I think they didn't cut because of the huge uncertainty that we had going into Russian sanctions, winter, SPR releases, everything else. But now I think unless we're moving towards 100, they're gonna act to help that on its way. Definitely part of the call here.
Before we get to your pairs trade, Paul, I wanted to see how you thought about China with its sudden and drastic reopening, which is resulting to a point where they're not even testing anymore. They're not PCR testing. They're not keeping track of COVID cases. It's just too overwhelming. So is the situation in China, is that going to be a tailwind or a headwind for oil prices?
Well, I was with the Chevron CEO on the road last week or so, and the concern is they don't have the healthcare system to manage a really bad issue here, and so it's extremely difficult to call. And actually, Mike Wirth, the CEO of Chevron, called it the biggest macro uncertainty of 2023, which is to say, of course, there'll be a recovery in economic activity as you open up against COVID zero. But then again, they don't have a good vaccine and they don't have a great healthcare system. So that's a brute. The IEA this morning reported its oil market report, and they've got pretty aggressive numbers in for China growth, actually, interestingly. They've also got aggressive cuts in Russian supply. And if you combine those two things together, their note this morning read very bullishly.
Okay. And your pairs trade, Paul. We'd love to do this. It started as a fun thing, but it's turned out to be something that we just. The last one was what? Short Ford?
No, well, yeah. Actually, it was long E&I. We thought the Europeans would have a good run, and the E&I side and the Italian major actually worked okay. In fact, Karen, to give her credit, said better Tesla than Ford, and I said, well, I'm just doing ticker E versus ticker F, but I agree with you on Tesla, and that trade kind of worked, but I credit Karen with the call. This time what we're saying is, look, there's an oil supply problem globally. We know that it's out there, and we do think that oil service is going to be a great way to play a bullish oil run here. So we're liking Halliburton. We could have said Neighbors. If you want some real hair, you could have gone with Rig Transocean. But we're saying Halliburton on the long side. One thing the IEA is highlighting in their report this morning is bad petrochemicals, really bad. It's a nasty combination of weakening demand and high input costs. Again, if input costs are going to go up, which would be crude prices running in the way that I'm calling, we're saying short Westlake, but you can short almost any petrochemical play here against Halliburton, and that's bad.
Paul, thank you. Good to see you. Paul Sankey, Sankey Research. Tim?
So $120 oil prices would seemingly be great for oil equities, except for it's not. High oil prices are not an environment to necessarily be chasing oil stocks because no one believes those prices are sustainable. If you think about where most of these integrateds and some of even the upstream folks are priced, it's off of probably a $70 oil curve, which is clearly where we are. I've been long Halliburton, I've been long Schlumberger for 2 years, and I think there's a lot more to do. The oil offshore drilling market is getting very tight. So wells that were drilled but not completed have all been maxed out now, and there's a lot of fresh drilling that needs to go, and I think you can stay in this trade.
And you like energy, Michael.
We like energy a lot. We like it from a longer term basis, quite frankly, more in a secular point of view. We think the cyclical, listen, the demand side, if you really do get a recession, it's going to take energy a little bit lower, right? But on a longer term basis, we're very, very constructive energy and commodities in general. We think that's the trade for a higher inflation environment, which we're likely going to see for some time.
Grade Paul's pairs trade. Got it.
Badass. Oh, that's not a grade.
Not Paul.
This one?
The
Well, the
pairs
last
trade.
two have been unbelievable. This is well thought out. Short chemicals,
right.
long services. Yeah. I mean, we'll be back. He'll be back in February, and we'll be saying you're a genius call. Great call. OIH will be 320 by then. Westlake Lower, good for Paul Sankey.